Hello and welcome to Switzer Investing. I'm Peter Switzer, and on tonight's show we look at 4 stocks that viewers have been asking us about: Galaxy Resources, EML Payments, Zipco and Invocare. And I get my charts guy Mike Gable to show us the technical outlook for these particular stocks. I also asked Tribeca's Jun Bei Liu and Berman Invest Julia Lee to comment on these companies as well. I also get Jun Bei to give us her 5 long-term hold companies, and Julia will tell us her latest acquisition to a fund. And then the Switzer Report's Paul Rickard asks us, is it actually time to take some money off the table and sell stocks? That's the show, so let's go and talk to Julia Lee of Berman Invest. Well, joining me as she always does on Mondays, Julia Lee from Berman Invest. Great to see you, Julia.
Great to be here, Pete.
Okay, I asked you to give me an idea of some stocks that you hold for the long term. Now, that's a really hard thing because you don't have loyalty to stocks. I've always thought that. You always like to pick up the new momentum, but are there some stocks that you just can't easily give up?
I think one of our oldest holdings is Lynas, which we're still very positive on. And Lynas is a rare earth company, and still over 70% of rare earths is produced out of China, so they're responsible for supply. But last year, about 50% of the heavy rare earth concentrate they received from Myanmar, which of course is seeing civil unrest at the moment. Yeah. So there's a lot of concern that there could be disruptions to supply, and that's helped prices. So if we have a look at neodymium or PR, that's gone up by over 30% just in 2021. Yeah. Now, Lynas comes out with a report tomorrow, so hopefully it goes well, given we're talking about it. But the last quarterly, we saw record revenue, and since then, prices have once again jumped. And back then, when we were having a look at the December quarterly, capacity was at 75% because of the COVID situation in Malaysia. And over the next couple of quarters, we should see capacity continuing to increase as some of the vaccinations are rolled out. So still positive Lynas. I mean, it goes into everything from mobile phones to military equipment, wind turbines, laptops.
It's a very, very modern resource, isn't it?
Yeah.
Okay, that's fine. Is there any other one? As I say, I feel as though I'm pushing you to do something that you don't really like to do, hold stocks for too long.
Yeah, I mean, there's a new one we've added to the portfolio. Okay, so this is probably high risk because I'm probably a bit too early on this one. But at the type of prices we're seeing in some of the tech stocks, I couldn't help myself. So we've added Altium to the position. ALU is a stock code, so that's electric circuit boards. The last half was disappointing because of COVID and I guess a change in their strategy where they are looking to cloud-based design, which I think, in 6 months, 12 months will really pay off. They did see their sales revenue going backwards, but
It's not the usual condition for you to buy a company, so there must be a gut feeling in there as well, is there?
No, I'm looking forward sort of 12 to 18 months to have a look at what companies have been impacted by COVID and are going to normalise.
Yeah, you have been talking about the reopening trade.
Yeah, the reopening trade. So I think Altium at these type of prices, there is the risk possibly of one more downgrade, but I don't think much more than that. And at these type of prices, I'm willing to take that risk.
Okay, now I've got Mike Gable coming up on the program, and I've asked him to look at a number of his charts, as he always does.
Yes.
Because these questions came to us in our Boom Doom Zoom show from the subscribers. So I want to throw a few at you, and the stuff the companies that you have a view on. Galaxy Resources.
Yes, so today we heard news coming through that Orocobre and Galaxy would be joining forces, I think. Yeah. So both of those companies did very well on the market. I think Orocobre was up 6%, Galaxy was up 4%. And look, the combination of those companies really does put it on the radar of international institutional investors. Yeah. So I think it is a smart move there. And look, greener energy is a theme. So I think lithium as well as graphite is a really positive story.
Now, this is a company I'm sure you introduced to me, and it's been doing well lately. I'm not sure whether you gave up on it, but I didn't. EML.
I still like EML. Look, EML shares have come under pressure because I think the chairman offloaded some of the shares.
What, recently?
Recently, so I think...
After a nice rise, recently. Okay.
After a nice rise. But look, EML Payments is one of these companies which I think is in the right place at the right time. And look, they've just made an
part of the
acquisition.
reopening story you had,
Reopening story. Look, their traditional business is in things like gift cards, rechargeable cards, but now they're moving into things like fintech, offering banking services to fintech through their recent acquisition. And look, I think the next 3 to 5 years is going to be a really exciting time for
good
EML
diversification, I thought. We interviewed Tom Cregan last week from EML, and I thought the bottom line was, well, they're diversifying. And he also made the point that casinos aren't really important, but the digital part of gambling is good for them.
Digital, and look, here in Australia, they're talking about rechargeable cards for casinos to try and track the money and stop money laundering.
And less handling, I guess, as well.
Yeah, and EML payments, they do rechargeable cards and deal with casinos as well.
Okay, well, I know you're an Afterpay fan, but I'm a Zip fan. But what's your view on Zip?
Look, they're growing really strongly, and there's been talk that Zip could potentially look at a NASDAQ listing to try and increase, interest from US investors. So, look, Zip is growing faster than Afterpay. I like Afterpay because the millennials number of people that they have downloading, so in terms of scale. So I think the top two in terms of the buy now, pay later are Afterpay and Klarna. And Afterpay, I think, is going to have a really good first quarter. So we have seen the shares recently rising from the low of around about $100 to $128. And I think the next update should be a very positive one, given on the back of the number of app downloads that they've seen.
I did like that ad of Nick Kyrgios where it says, "Should I zip it?" Which I thought was quite a funny ad. Let's go Invacare. Not a kind of stock I imagine you show much interest in. Really feel a pet that night. Used to like it many years ago, but what about you?
Invacare. Yeah, when we first heard about COVID-19, I tried to put aside the emotional part of my brain and look at the logical side. And I thought, death rates are going to go up here in Australia. And we bought into Invacare, but actually it's been the complete opposite. So we sold out of Invacare. And the strange thing about death rates is that if they're abnormally low in 1 year, then there's payback in future years. It seems to be that when your time is up, your time is up. So look, there's been extraordinarily low death rates here in Australia and New Zealand because of how we've tackled COVID-19, social distancing, washing our hands and hand sanitizers. But I guess there will be some sort of payback over the next 2 or 3 years.
I kind of think normal flu will come back and people die of normal flu at much higher rates than the coronavirus because we don't sort of fight that kind of flu as well as we fought coronavirus. Yeah.
Look, I think in the funeral service space, the risk is that part of the story has been a roll-up model where there's acquisitions that help boost the value of the company. And my fear about the funeral space has always been that there could be a low-cost operator that comes in because funerals are pretty expensive. But if you had a budget model which gains scale, I think that would be a risk.
Can I ask you this social question, Julie? I never do this to you on air, but as a consequence of coronavirus, when you travel on planes, do you think you'll wear a mask? Because I've always thought, I'm hanging out with a whole bunch of sick people in winter. Any of these people could start coughing and I could get a cold. Do you think a lot of people might start wearing masks?
I think you make a really good point, Pete. We've had COVID-19 for so long now that it has changed behaviour, not only in terms of masks, but how we go out and how comfortable we feel when we're eating out or even travelling. And some of those trends are going to be difficult to reverse. So you might see initial spike up in travel, but maybe people will come to realise how much money they've saved through COVID-19 and go back to the previous ways. So that's part of what I think about now in terms of trends, sort of what's sustainable, what's going to see an initial spike out of the gates and then quickly reverse back down. And to that end, I look at China only because they've dealt with COVID-19 before other economies to work out what those travel trends are like. And it's actually quite interesting looking at it country by country. In China, domestic travel is very strong at the moment, whereas international travel isn't. Whereas over in the US, domestic and international travel is quite strong and it's forecast to be very strong. But over in the UK, both are forecast to be relatively low. So behaviours are different country by country and different economies as well. But yeah, I'd wear a mask.
Yeah, I think I might too, at least, particularly during winter, but that's Maybe I'm getting too scared. Anyway, Julia Lee, thanks for joining us as always. That's Julia
Great
Lee
to be
from
here.
Berman Invest.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Join Paul Rickard, Hamish Douglas and myself and a range of other financial experts as we share with you key strategies to help you grow your portfolio at our 2021 Virtual Investor Strategy event taking place on the 27th and the 28th of April. Please join us. We are currently offering free registration to this event as well as a bonus 7-day free trial to the Switzer report for anyone that registers. So get in quick and secure your spot via the link in the description below. Well, I've got Mike Gable from Fairmont Equities on the program now, and some of the stocks I've asked him to run his technical eye over are stocks that were put to us in our Boom, Doom and Zoom show for the subscribers to the Switzer report, which goes out on Thursdays. And sometimes when these stocks come along and a lot of people are asking about, I then want to know what the technical analysis is saying about these companies. So there's no particular preference, it's just basically what people have been asking me, and I want to know what the technical charts are saying. Mike, thanks for coming on the program.
Thanks, Peter.
Let's go to Galaxy Resources first. So what are you seeing there, mate?
Look, it's a very positive looking chart. I really like the way this has been trading over the last several months. It's a very nice sustainable trend. It has a bit of a run, then it consolidates the move and gets going again. I mean, we actually had this in our weekly newsletter 2 weeks ago, looking at the stock going on another run, and we can see in the last couple of weeks it's run very hard.
Show how brilliant you are, Michael.
Yeah, this is one that's worked. So what I've indicated with these lines here on the chart is, it has come back to a very good support level over the last couple of weeks and then got going again. The thing is, though, if you're looking to chase it here, you're buying something that's, already quite hot. So what I prefer to do is wait for the share price to go sideways, have a bit of a pullback, just calm down a bit, which is what we saw on prior occasions in December and then again in March. So look, if you're holding it, this thing may well pop up another 50 cents a dollar, you just don't know.
Yeah.
But again, to buy it here, it might just cool off back towards, say, $3. So
and you're saying that there's been an announcement that Galaxy and Aracobra are going to do a merge.
Yeah, so just out today, merger news. So, we'll just have to see what the market does over the next few days, whether it does push it higher or whether we get a bit of profit take in it and it cools off. But look, longer term, the trend's quite positive. I just prefer a better entry point than buying it up here.
Okay, good one. Let's go to InvoCare. InvoCare, of course, is in the funeral business. Was a sensational performer for a while. Did a lot of acquisitions. Didn't do really well over the coronavirus period, probably because the government did really well in stopping the deaths. Death rates have actually fallen.
Well, that's right. Unfortunately, for their business, death rates were lower because everyone was sitting at home, not
wearing
going out.
masks and behaving themselves.
Exactly.
Less flu.
Plus, whatever funerals were happening were at a much subdued level, so people weren't spending as much on funerals. So when you consider all of that, perhaps InvoCare is a good beneficiary of the reopening of economy, people going back out and putting themselves at risk and people having better funerals again. But the share price action, it just doesn't seem to be reflecting that potential upside. I know it's a business that has had issues with competition and cost issues. And what I'm trying to show here on the chart is that unfortunately every time the shares try to rally, there is a lot of selling. So we could see recently up at $12.50 in late January, the share price got up there, was sold back down. $12 also seems like an obvious level. And then most recently, I've indicated with another horizontal line there on the right-hand side, around 11.50 seems to be a bit of a ceiling in the share price. So unfortunately, look, I think if you were to buy it here in anticipation that the reopening would benefit the shares, you're just going to be stuck in a stock that's going nowhere while the rest of the market's trending higher. It just seems like there's a lot of selling at multiple levels. You almost need to be paying $13 for this stock, just knowing that it's cleared all of that selling. So unfortunately, Peter, it's not one I'd be keen on.
And Michael, interesting, if you got in September, it's been a really nice ride up, but it really, the market is sort of saying, this is enough, at least for the moment. It may have another kick up when life becomes normal and people are dying at normal rates, but at this point in time, not looking great. Let's go to the next one, and this is EML. This is a part of my famous Z group of stocks. It's been doing pretty well for a while, but got some news out recently about an acquisition. The market seemed to like it. What are the charts saying to you, Mike?
Yeah, look, it's looking really good. I have to admit, in early January, I didn't quite like the look of this, but by February it was shaping up quite nicely, and it definitely looks really good now. I've put a couple of horizontal lines there. So across January, February, there was a clear resistance level just under 450, and then in mid-February, as we could see, it jumped up above that resistance level, and the part of the chart at the bottom, those bars there, that's the volume. So we could see a huge spike in volume when the shares jumped up in February. So if anything, that was your buy signal if you weren't already in the stock, because that's a very positive sign to see that much volume go in. And then of course, it didn't really kick on for several weeks, but we could see it only went sideways under another lid in the share price, just under 550. And then at the start of April, jumped above that. We can see another spike in volume. And it's holding in there. So look, this one's stepping up quite nicely. This looks like a nice sustainable uptrend. Obviously the acquisition news is good for EML, very good for EML, and the market's liking it. I think this will continue to head higher.
And it's a classic reopening stock, isn't it? Because it's in the gambling space, it's in the shopping centre, gift card space. And of course, the more we get back to normal, and it's not just here, like we might be back to normal, but right around the world, shopping centres are not back to normal, and these guys play in all those sorts of spaces. Let's go to the next one. That's a favourite of mine, like EML, is Zip. And once again, people ask us this on the show because they know I've been associated with it. It's had enormous spikes and then enormous falls and bounce backs again. What's the latest on the chart showing you?
Yeah, look, generally it should head higher, although I think compared to some of the other buy now, pay later stocks, it just looks a little bit leery to me, a bit risky.
Leery?
Yeah,
that's
so
a good word.
look,
What's that
preferably, yeah, it could turn around and bite you in the backside. But no, look, I think it should be fine. But I'd rather an entry point after a share price has settled down and consolidated. So if we have a look, sort of in the middle of the screen there at the start of January, where I've put those diagonal lines, we were having a chat here in early January, and I mentioned, look, this thing looks like it's ready to have a bit of a run because the price range was tightening up. It was looking like it would want to break, and obviously it had a massive run late January, February. It's come back down. Where I've circled is where it gapped up at the start of April, which was the next buy signal. But I have to admit, on that day for our clients, we bought Afterpay as a trade instead of Zip, only because, as we could see over the last couple of months, the share price is, it is sort of all over the place. You've got these big daily ranges, as we could see on the candlesticks. So they're very large candlesticks, meaning that intraday, it's, as we've seen recently, it could move sort of 10% intraday. So to me, it's a bit risky, almost a bit too volatile for me. So look, we're in Afterpay at the moment, not Zip, but generally they should head higher together. I mean, Zip's announced, they've had a couple of great announcements, of course, in terms of growth in the US. They've raised the cash there as well, which is a positive for them. So, look, I think they should generally continue higher. Of course, the other...
expect a bit of a ride.
Yes, exactly. Look, I think the only thing that will stop Zip is, US bond yields and what the Nasdaq does. That seems to be the only sort of issue at the moment with these sorts of stocks. But look, at the moment, to me, it looks like it should continue to grind higher.
And the interesting thing of both Afterpay and Zip experienced that big drop-off, because that's when tech stocks were being dumped right around the world because of the,
Yep.
the US bonds
Yeah.
yields going up. But it didn't take long before people decided these tech stocks have been oversold. It seems to me, Mark, and this is a side issue, if we accept that there's going to be a substantial economic boom over this year and next year because of the amount of spending and interest rates being held low by central banks, it just seems to me these tech stocks are going to be beneficiaries, even if they don't rise at the same rate as some particular stocks that benefit from the rotation into reopening. It just seems to me that it's a growth industry, and America at this point in time are way behind us in terms of buy now, pay later.
Yeah.
Is that your reading of it? Because you're in Afterpay, you must have a reason for it.
Yeah, definitely. Look, I think that these businesses will continue to grow rapidly. The only sticking point is how the market values those stocks. So I think investors have to be aware that these stocks might go through a period of time where, you know, the business is growing, but the share price isn't growing. And that might seem odd, but it's because we have to also look at interest rates. And unfortunately, what interest rates do, what the market's perception of interest rates are, perception of inflation, is that will affect the share price, you know, in short and medium term periods, as we've seen with Zip and the other tech stocks. At a short period of time, a movement in interest rates has massively affected the share price, even though the underlying business has continued to do well.
Yeah, that's right. So the last one is Mike's selection. I always ask him to come up with a company that he likes right now. The charts are looking a little bit exciting. And this is WSA Western Areas. Tell us about this, Mike.
Yep. So look, Western Areas is a nickel producer. We're still bullish on the commodity space. We still believe that lowering US dollar, government stimulus, improving economies, it's basically good for commodities in general. So Western Areas produces nickel. Nickel's used in stainless steel. Of course, you've got the backstory of the use in electric vehicles, but without getting too caught up on the story, they're making stuff which is going to be used over the course of the next year or two. So with this particular chart, I think Western Areas has given us a buying opportunity right now. So we could see that, look, the share price did get smashed across January, February, March. They raised money at that low point in March. And then we saw the share price start to tighten up. So a lot of the heat started to come out. A lot of the volatility started to come out of the stock, similarly to what I was pointing out with Zip earlier in January, where I had that tightening of the range. So we've seen that now with Western Areas. Then at the start of April, it gapped up. So that's what I've circled there.
Yeah.
Gapped up. It's gone sideways since then. So again, it's sort of gapped up, started to settle down a bit, and it's getting ready for the next run. So this gives, I think, a really good risk reward. So if you're basically looking at this chart saying, okay, well, it probably gets back up towards the previous January peak of 310, and then there might be some sellers, or it might come down in the short term towards $2, which is where it was only a few weeks ago. And in terms of a risk reward, you're risking, say, 30 cents there to make, maybe 70 cents, 80 cents potentially on the upside.
And a fair point to make is that and people are making that suggestion that we've got another mining boom in train. The last time the mining boom was pretty active in 2011, this stock got to about $7, didn't it?
Yeah, exactly. So if we're part of a new super cycle or whatever you want to call it, there could be substantial upside in these sorts of stocks.
Love a super cycle, mate.
Exactly.
That's Mike Gable from Fairmont Equities. Well, I'm catching up with Jun Bei Liu from the Tribeca Alpha Plus Fund, and great to see you.
Good to be here, Peter.
Yeah. Before we start talking about stocks and whatever, some people are wondering whether it's time to take money off the table because it's sell in May and go away, or is the power of this potential economic boom so significant you wouldn't be interested in selling and running away?
Look, my view has always been that invest with long-term in mind. To be tactical, yes, the market has gone up quite a bit. Next 3 months, we should see a fair bit of volatility, just given there's a lot of good news in the market, and market's done well. So if you want to be tactical, yes, but the biggest problem of taking profit is that when you take profit in a lot of blue chip and high quality business, is that you miss out. And then when you miss out, then you have the behavioral bias of saying, I don't want to go back in. And, so that becomes, you have to time your, time the entry, time the sell, and time. It's a lot of work. It's a lot of work. So my view is always, if this market sells off, you buy more of those quality companies.
You and I totally agree. Yeah, I must admit, when I like good quality companies I've had for a long time, they've done well. If the market wants to dump them,
you buy more of it. Absolutely.
Okay, let's talk about the long-term holds in your fund. What are they?
Plenty of them.
Yeah. Well, give us the ones that you,
Sure.
There are plenty of them, but I'm sure there are ones that you think, I have to have these in my portfolio.
Absolutely. Woolworth is the first name that comes to my mind. It's the share price actually has underperformed the rest of the market for a little while, simply because they've done such big numbers because of pantry stocking, and now they're going to have a bit of a difficult trading period just because it was so strong last year. Use that as buying opportunity. Great business. You've got catalysts along the way of separating the drinks business. We think that business will deliver significant long-term value for investors.
So that's the Dan Murphy brand you're talking about.
That's right.
Yeah.
Absolutely.
So Woolworths is your first one, and do you think when they separate it and put the drinks business into a separate listed vehicle, those people holding Woolworths shares will effectively have two companies, and do you think both of them will have upside?
Absolutely.
So
we have seen so many times when companies separate those business and the investors just have a lot more visibility, and in turn, both of them actually generally deliver return for investors.
Yeah, because like for example, Coles has done very well after leaving Wesfarmers.
That's right. Yeah.
And it means that there's more specialty concentration on that particular business.
Absolutely. Yeah.
Okay, that's the first one, Woolworths. What's your second one?
Second one will be Cochlear. It is one name that you can just buy and put in the bottom drawer. Last 12 months has created enormous buying opportunity because of disruption caused by COVID. And now the share price actually still underperformed the market. It's gone up a little bit since the bottom, but still underperformed the market. Good buying opportunity to buy a quality defensive that will deliver growth, structural growth. That's regardless of the global economy is recovering or recession, or this company will grow. So my view is that it is something they should have in the portfolio.
What's the rivals to Cochlear looking like?
Rival actually struggled during this period, whereas Cochlear, even though some of the disruption caused by hearing centres being shut down and surgery couldn't be performed properly, what's really good about it is that the minute the normalcy returns, we actually seen the backlog being filled quite quickly by Cochlear, whereas compared to some of the competitors, they aren't pulling it through as fast as they are.
That's number two. Number three.
Well, number three is an interesting one. I would put Afterpay in the mix for me. That's right.
It's come from nowhere to be a blue chip must-hold stock.
That's right. Yeah. It certainly has done incredibly well. If you look at the long-term, it's a 12-month performance. It certainly is a very hot sector. But my view is that this company share price will be a whole lot higher in 2, 3, or even 5 years' time compared to what it is today. Simply because what it has shown in its ability to grow its addressable market. US, Australia, it's got 4 million active users, and the US market, they only went there a couple of years ago, and now they already have close to 10 million active users, and this is just still at its infancy in that market. Tip of the
iceberg.
Absolutely, and then there's the UK, Europe, and it's an enormous amount of opportunity, and not just Afterpay itself, and there's other adjacent product that they started launching now. It is a fintech. It is going to disrupt a lot of old businesses in that space.
Okay, so that's Afterpay. I'm going to have to ask you, do you also like Zip, or because you like Afterpay, you don't like Zip?
I think that whole space is very, very interesting. Zip, tactically, when we talk about tactical performance, it's gone up 15%. Obviously, it has fallen quite a bit. In the short term, potentially, there's a chance for pullback. But our view is that top couple players, number one, number two, generally make it through in those innovative sectors. You need to keep watching on how they're going in the US, because unlike Afterpay, they actually bought into the US, whereas Afterpay is organic growth into the US market. So as long as that business is tracking very well.
That's the QuadPay business.
That's right, yeah. Then they should do quite well.
Okay, that's three. What's your fourth one? I'll push you for 5. How about
Let's find quite a few big ones. The next one is Ramsay Healthcare.
Yep.
Now we stick
That's
to
a buying opportunity.
That's
now,
right,
isn't it?
absolutely. The share price has hardly moved. It's done a little bit better than the rest of the healthcare sector, like CSL and the like. But my view is that this is a premium hospital asset. There's enormous amount of opportunity for them to create value within its business. Share price impacted by the earnings sort of evaporated when the hospital beds were made available to the COVID cases.
Yeah, and they're dealing with other countries, aren't they? Like they're in France, they're in Malaysia, I think, aren't they?
That's right.
So, in a sense, they were forced to sort of, like the banks, be a part of the rescue program, which in a way got away in the way of their profitability.
That's right. And unlike other healthcares, this one earning actually will do quite well when the world returns to normal because of the beds now open and available. And what we know is that the waiting list is enormous. So this company has high fixed operating leverage, which means when revenue goes up, the profit will go up higher. So for the next few years, the company is in a very good position.
Okay, number 5.
Number 5, actually that one can be a little bit higher up the list as well. That is the Treasury Y. Now we've seen very significant long-term value for this business. Business clearly has been impacted by the China and Australia relationship and then the tariff that's put in place that affected its China distribution. Now, great brands at meaningful amount of discount to its true valuation. I just think it's a business that perhaps won't even be listed for very long.
Oh, you think a private equity group might come along and buy it?
Oh, absolutely. If the share price stays low, we have seen so many M&As in the last 12 months, and if anything, we will see more of it. Treasury actually has been rumored by either private equity and listed players offshore about looking at its business. So, it's already generated value by selling some of its asset in the US, and the recovery in its business from the post-COVID world has been actually very strong. So, this is one brand that is still at quite a cheap valuation in today's market.
Yeah, so that's interesting because we've even seen Virgin's been taken off the market, bought by a private equity group, and that's not as good a business as Treasury Wine Estates.
Absolutely, and a brand is hard to create, and with money is very, very cheap at this point. And especially, what's interesting is that easy to get money, very cheap, interest rate very low. At the point of now that people start talking about bond yield going higher, so the expectations of future interest rate going higher is creating a sense of urgency for deals to be done, because lock in your money now and buy something. And for brands like that, it's very difficult to reproduce, and certainly worth a lot more in the hands of a larger brand.
Great 5, interesting 5, not boring at all. A couple of boring ones, but still good. Now, before you go, Mike Gable from Fairmont are going to look at a number of stocks that were asked questions of in our Boom Doom Zoom show.
Sure.
I just want some quick views from you. Galaxy Resources, what do you think?
I like it. The announcement of merging with Orocobre is very, very interesting. I think certainly in this space, because it's emerging, there's a lot of demand for lithium products. Certainly larger is better. And the combined business will become more, more competitive entity. At the moment, IGO is still the largest, even after the combination. But I think that whole sector certainly is very interesting indeed.
Okay. Invacare.
Oh, that one's a little bit tough. Look, it just I think it will be the reopened play as well. As more people are able to attend the funerals and the like. But the issue with this problem is that it just aren't able to grow this business because the competition, individual operators have become quite efficient, and there's been a lot of refurbishment money throwing in the industry by the little players, and so they've been losing share for years. So yes, they may do okay, when the world returns to normal, but it's very hard to see them really come through as a meaningful largest player without the market share leaking.
EML.
I like EML, and again, another reopening play. Acquisition last week or 2 weeks ago really adds to the new perspective for this business. I think it will do well. Share price has had a big rally. Potentially, I think in the market, there might be sell downs and a few of those things coming through. So might dampen some of the enthusiasm, but the business itself is doing very well.
And Western Areas.
it gives a really gives a good exposure to the nickel side of the business. And I think at the moment they're all looking very strong, given where the world growth is going to come from. Especially nickel has a good exposure into that EV space as well, electric vehicle space, and that is going to be the future.
Yeah, so you're not expecting the commodity cycle to end anytime too soon?
Not at all. I think the commodity is a good place to be, especially if in the future, in the next 2 years, you probably will start seeing some inflation coming through. Commodity normally is a really good hedge in that.
And are you expecting a bit of a super cycle for commodities?
Look, I'm not sure about the super cycle. I certainly see steady growth coming through. I think the demand for a lot of those products will come from electrification and all of those newer areas, rather than minor, heavy material requirement from China throwing at the infrastructure and the like. Because if anything, China will slow somewhat when the rest of the world return to growth. So, to me, it's a steady growth, and focus on some of those names that has those exposure, like more electrification and those newer space.
Okay, Jun Bei Liu, thanks for all your contributions.
Thank you very much.
That's Jun Bei Liu from the Tribeca Alpha Plus Fund. Well, joining me now is Paul Rickard from the Switzer Report, and Paul's advanced the idea that maybe it's time to take some money off the table. It's been a nice run up for stocks, and he looks as though he's getting a little bit nervous. Are you getting nervous, Paul?
No, I'm not getting nervous, Peter. In fact,
courageous.
yeah, if anything, look, I probably don't think you should take money off the table, but I did ponder the question in the Switzer Report today, and I guess the arguments for taking money off the table are sort of like, well, we're at all-time highs, at least in the All Ords. We've had a huge rally here locally. We know markets always look forward. We know the economic statistics are fantastic, but they should be, and that's what the market is telling us. And we're seeing just a little bit of frothiness in things like the price of Bitcoin and other cryptocurrencies, frothiness in the things like Coinbase. There's a lot of stuff happening out there, Peter. I mean, you get it in a cab these days. I go to dinner with my mates, everyone's talking shares. You wonder how much longer it can go. So I work on the basis I'm never going to get the top of the market. And so, there's an argument to sort of, just to take some money off the table. But that said, against that, of course, is that the market's only just clipped over to a high on the All Ords. We haven't quite got there on the S&P ASX 200, and we know historically that when markets make new highs, right, and that they go well past the highs.
So before they crash again.
That's all going forward. We've got the Reserve Bank saying that interest rates aren't going up to 2024. That's still
unbelievable.
3 years away. Now, if interest rates stay at 0.1% for the next 3 years, the rush for shares with dividend yield
we're going to go
so
10,000.
right?
We're going to go 10,000. If they're going to stay there, I think stocks have to go 10,000.
And you and I both think that he'll change his.
The boom will make him raise early.
He'll raise early, but look, let's just play that one out. And then thirdly, we use other indicators and a lot of forecasters out there who do long-term predictions, and they still think the Aussie market is, comparatively reasonable value.
Yeah, the good point in your story was you talked about, what's his name? Farrelly.
Yeah, Farrelly Investment Research.
Yeah.
And they basically think the market's not fully priced till about 8,000 and not overpriced till about 9,000. That's on the All Ords. So, and this is a long-term model, so there are some powerful things. So I probably came out of the point of view that it's probably a little early to take some money off the table, but I also understand from a comfort point of view. We were down at 4,500 less than a year ago. It was the 20th of March last year. We got 4,500. We're now over 7,000. The rise has been so quick, Peter. Look at any chart. The last 12 and a bit months, you've never seen a steeper rise in the Australian market. And I guess the same a bit in the US, and that makes you feel a bit. We know things can't go up. They don't go forever, and when things get very steep, eventually you'll get a bit of a correction.
Yeah, and the thing is history's a bit tricky because we're living through a time when, if I said this time is different, it really is different. Interest rates have never been this low. Governments have never spent this magnitude of money. It really is different. So the outcome could be very different.
Yeah, and you and I have been saying the economy is absolute gangbusters. I think that's going to continue. So. Look, I think there's more in it, but I can understand why you might want it. So I guess that leads to the question of where should you do it?
I want to ask this question. Are you saying then some stocks might be ripe to sell but you wouldn't necessarily sit on cash. You might move into it, like rotate into a different part of the market.
Yeah, look, I might go a little more defensive. I don't think there's anything wrong in being in cash, Peter. You just, I mean, at least you know you're going to have your 0.1%,
Yeah.
whatever it is.
Yeah.
And, you know, your retirement plans will just go off and off, but at least you won't lose capital.
Yeah.
And, you know, cash could be, you know, if you get out of the reduce your market exposure, don't be afraid to go back into cash for 2, 3, 6, 12 months, 18 months, however long it takes. I mean, you could also go a bit more defensive and go into some more defensive style of assets and equities as well. Right?
So, and also you could be saying, sell in May and go away, come back in November.
Yeah, you could just
when
be
the market
short-term.
often takes off.
So I guess what can you look to lighten? Well, let's deal with the obvious first. The obvious is that you've got to use bull markets to get rid of the crap, right?
That's good.
So, you know, it's really hard to sell bad stocks in a bad market because the market gets very selective. And we all have portfolios where we know we've got a couple of stocks that we've really held on to too long. We know that they're, you know, not really going to perform.
Mine's Atomo Diagnostic, which Bill Gates, you know, and I think Lang Walker all went into it, and they went down straight away.
Okay, so get rid of the rubbish first because it's only in a good market you've got a chance of getting out of it, right?
Yeah,
it's in a
true.
bad market, no one will want to touch it. And one thing the market keeps teaching us time and time again is that quality pays, right?
Yep.
So
Yep.
get rid of the stuff. Then I think there are three sort of things strategically you could look at. The first, I think, is resources. I'm not super bearish on the resources market, Peter, but I do think iron ore, when iron ore is now up almost $180, it's at the same price it was in 2011, 2012.
The super cycle boom.
The super cycle boom. We know that, look, this is not just a function of demand, it's also a function of supply. In other words, that the biggest producer in the world, Vale, has had their supply disrupted. It's been disrupted a lot longer than they expected.
Brazil's coronavirus problem.
Brazil's still got the problems of the coronavirus. Eventually, you know, they will get back on top of the supply. We know there are other junior miners, people like Mineral Resources, talking about expanding. Eventually, supply will come back to the market. So I think there's a bit of a supply dynamic. So it doesn't mean iron ore couldn't go to $250. It could, but and I'm not saying cash all out all your chips on these companies, but because they're all priced.
But you wouldn't definitely acquire this level.
But I think if you're being fully weighted or even overweight, it's time to ease back a touch. So that's option number one. You could also look at some of the other resource companies, although I don't think, you know, the ones in nickel, copper, some of the base metals, I don't think they're quite as exposed as the iron ore miners. So that's the first strategic area. The second, I think, is to look at the US, and that's because the US market has been so strong.
Yeah.
And it's comprehensively outperformed Europe, the UK, Japan, and Australia over the last decade. Now we know why, because they've had the tech majors have been there. They've been probably the most advanced in terms of digitisation. We also know that they've had very supportive policies under the Trump environment, and under Biden, they're just money's coming everywhere, right? Through the pandemic.
Yeah.
But you know, you've got to think at some stage the rest of the world might catch up a little bit. And if you are looking at coming out of equities, you know the US market will probably lead it anyhow. So maybe that's the place to sort of lighten off a bit first, all right? So I think that's the second sort of question. The other concern I have about the US is if you're unhedged, I still think the US dollar goes lower, the Aussie dollar goes up. So that's the second one. And then thirdly, I guess, is to look at some of the securities in your portfolio trading on higher PEs, higher enterprise to sales multiples. We've seen that this has been a bull market led by growth stocks. Value's come into it more recently, but you know, in a correction, you've got to think it's going to be the growth stocks that are going to suffer the hardest. So some of the tech majors, some of the consumer discretionaries trading on very high multiples, some of the 2B companies. I think the whole you know, buy now, pay later sector. I like the sector, but it's so overpriced. I think in a tough market, you know, value will come back into that. So they're the areas to look at in terms of your portfolio if you want to cash in some of your chips. I'm not suggesting you do, but I can understand.
But if you're nervous, this is the blueprint for nervousness.
You know, saying, you know, over the next year or two, markets will peak and let's do a little bit now and do some more in 6 months and some more in 12 months. That's not a bad strategy too, because one thing I do know is you won't and I can't find the peak, right?
No.
It never happens, and so you've got to take some of the action before.
So you either get out before or you sell as quickly as you can when it falls, but sometimes everyone's running for the exit at the same time.
Yeah. So I think a bit of trimming, I can see why you might do a little bit of trimming in these sort of conditions. But we and I both think the market goes higher, so but we'll give it
Yeah.
Bit of everything.
It's a tough call, you know, but someone has to do it. That's Paul Rickard. If you want to read his story and you're not a subscriber to the Switzer Report, we'll take our free trial and read it. I'm Peter Switzer. Thanks for joining us. We'll see you next week.